December 2, 2001. Houston, Texas. Enron, once the seventh largest company in America, a titan of energy trading, a darling of Wall Street, files for bankruptcy. It's a shockwave that reverberates globally. Just months before, its stock was trading at over $90 a share. Its executives were hailed as visionaries. Its culture was celebrated as innovative. Suddenly, it's gone. $63.4 billion in assets vanish. Thousands lose their jobs. Billions in shareholder value evaporate. Retirement savings are wiped out. The cause, not market forces, not a natural disaster. It was fraud, massive, systemic, audacious fraud. Enron had been cooking its books for years, hiding billions in debt and inflating earnings through a complex web of shell corporations and accounting tricks. But here's what makes this more than a financial scandal. Enron was filled with some of the brightest minds in business MBAs from top schools, brilliant traders, savvy lawyers. They called themselves the smartest guys in the room. So why did an entire corporation, staffed by intelligent people, engage in such self-destructive deception? The answer is psychology, the psychology of arrogance and overconfidence, the psychology of unrelenting pressure for growth, the psychology of groupthink, and the suppression of dissent. This is about what happens when a corporate culture, driven by ego and a relentless pursuit of profit, loses its ethical compass, leading to a spectacular, self-inflicted implosion. Enron wasn't just a company, it was a cult of personality and performance. Led by Kenneth Lay, Jeffrey Skilling, and Andrew Fastow, it fostered a culture of extreme ambition, ruthless competition, and unbridled arrogance. They truly believed they were the smartest guys in the room. This created a powerful overconfidence bias. They believed their intelligence and innovation made them exempt from traditional rules, both financial and ethical. They were pioneers, not bound by old-fashioned accounting. The core psychological drivers were unrelenting pressure for growth. Enron's stock price was its lifeblood. Executives were compensated with massive bonuses tied directly to reported earnings and stock performance. This created an insatiable demand for ever-increasing profits, regardless of how they were generated. The mantra was growth at all costs. Then there was the Performance Review Committee, or PRC. Enron had a brutal internal ranking system. Employees were constantly evaluated, and the bottom 10 to 15% were fired annually. This created an environment of intense fear and competition. People would do anything to avoid being in the bottom tier, including cutting corners or manipulating numbers. It fostered a kill or be killed mentality. They also used mark-to-market accounting. Enron pioneered this method for its energy contracts. Instead of recording actual profits when a deal was completed, they estimated future profits and booked them immediately. This was legal, but highly subjective and easily manipulated. It fed the illusion of massive, instant growth. The illusion of innovation. Enron presented itself as a revolutionary company, transforming the energy market. This narrative of innovation provided a powerful psychological shield. Any questions about their complex accounting were dismissed as critics simply not understanding their genius. This is confirmation bias at an organizational level. They sought and accepted information that confirmed their image as innovators, while dismissing anything that suggested fraud. Desensitization to risk. The company thrived on taking massive risks in new markets like broadband and weather derivatives. When these risks paid off, it reinforced the belief in their genius. When they didn't, the culture demanded they be hidden, not learned from. This culture, driven by a relentless pursuit of growth and an arrogant belief in their own superiority, created a fertile ground for unethical behavior. The pressure to deliver ever-increasing profits, combined with a system that rewarded aggressive risk-taking and punished failure, slowly eroded ethical boundaries. The smartest guys in the room believed they could outsmart everyone: regulators, investors, and even reality itself. Enron's innovations were not merely about trading energy. They extended to creating financial structures so intricate that few understood them, and even fewer dared to challenge them. The core of the fraud lay in its use of special purpose entities (SPEC), also known as Raptors or LJM partnerships. These off-balance sheet entities were meticulously designed to hide Enron's massive debts and failing assets, creating an illusion of financial robustness. These SPs were often managed by Enron executives themselves, blurring ethical lines and creating inherent conflicts of interest. They allowed Enron to sell assets to these entities, booking immediate profits, even if the SPs were essentially shell companies backed by Enron's own stock, making the sales purely circular and fictitious. This was the financial alchemy that kept the illusion alive. Here, cognitive dissonance played a crucial and corrosive role. Enron executives, immersed in a culture of self-praise and success, genuinely believed they were brilliant, ethical innovators. Yet, they were engaging in practices that were, at best, highly questionable, and at worst, outright fraudulent. This profound contradiction generated immense psychological discomfort. The gap between their self-perception as smartest guys in the room and the reality of their deceptive actions was vast. To reduce this dissonance, they employed a series of sophisticated self-deception strategies. Rationalization. They convinced themselves that these complex structures were innovative accounting, a way to push the envelope of what was permissible rather than fraud. The internal narrative was that they were simply ahead of the curve, operating in a new economy that traditional accounting rules couldn't grasp. The logic was, it's not illegal if no one understands it, or we're just being creative. The focus was on the letter of the law, often twisted, not its ethical spirit. This allowed them to bypass moral qualms by reframing their actions as ingenious rather than dishonest. Minimization. The risks associated with these entities were systematically minimized. Debts were not real debts. They were managed risks. Losses were not real losses. They were temporary fluctuations or accounting adjustments. This euphemistic language served to mask the gravity of the situation, both to themselves and to external observers. The inherent volatility and potential for collapse within these structures were consistently downplayed, blaming external factors. When deals went bad or SPE partnerships generated losses, the blame was always attributed to unfavorable market conditions, unfair competition, or overzealous regulators, never to their own flawed strategies or deceptive accounting. This external attribution protected their ego and reinforced their belief in their own infallibility. Focus on the greater good. Some executives may have genuinely believed they were building a revolutionary company that would benefit everyone, and that these creative accounting methods were a necessary evil to achieve that grand vision. The ends, in their minds, justified the means, creating a moral license for their actions. This allowed them to see themselves as heroes, not villains, even as their actions harmed countless individuals. This continuous process of rationalization allowed them to maintain their self-image as ethical, successful leaders, even as they plunged deeper into deception. The more they lied, the more they had to believe their own lies to avoid the psychological pain of admitting they were wrong and that their actions had real consequences. The outside world, including financial analysts and investors, was largely fooled. The sheer complexity of the structures, combined with Enron's reputation for innovation and the new economy hype, made it extremely difficult for anyone to discern the truth. But within Enron, the psychological toll was immense. The pressure to maintain the facade was overwhelming, and the dissonance between financial reality and the presented numbers grew exponentially every day. The house of cards was being built, brick by deceptive brick, held together by a fragile web of psychological elastifications that, in the end, would not withstand the truth. You've probably heard of Enron, the energy giant that collapsed in a spectacular firestorm of scandal. But what really happened inside those glass towers? It wasn't just greed, it was something much more insidious. Even as Enron was hailed as the future, some insiders saw the rot. Vice President Sharon Watkins wrote a desperate memo, warning that the company could implode in a wave of accounting scandals, but her voice was silenced. Why? Welcome to the world of groupthink At Enron, questioning the smartest guys in the room was career suicide. Their aggressive review system purged anyone who didn't fit the mold. Auditors from Arthur Andersen, paid millions by Enron, looked the other way. The board of directors, charmed by the leadership, failed to ask the tough questions. This created a culture of silence where rational people ignored obvious red flags. The few who dared to speak up were isolated and dismissed. By the time the truth came out, it was too late. The house of cards had to fall. It's a powerful lesson on how toxic culture can bring down even the mightiest corporations. Thanks for watching. December 2, 2001. Houston, Texas, the Enron Corporation, once valued at $60 billion, filed for bankruptcy. It was the largest corporate collapse in U.S. history at the time. Thousands lost their jobs. Billions in retirement savings vanished. The Enron disaster wasn't caused by a market downturn or a sudden, unforeseen event. It was a deliberate, systemic fraud, fueled by a dangerous cocktail of human psychology. The lessons are stark: overconfidence bias, the belief in their own genius, leading executives to think they were smarter than the rules, above the law, and immune to failure. Escalation of commitment. Once they started down the path of deceptive accounting, each new lie required another, deeper lie to cover the previous one. The cost of admitting failure became too high. Cognitive dissonance, the need to justify increasingly unethical practices to maintain the belief in Enron's innovative business model and its continuous success. Groupthink and conformity, a culture where dissent was punished, and loyalty to the Enron way meant ignoring red flags and participating in the deception. Loss aversion, the desperate fear of admitting losses, leading to the creation of complex, fraudulent schemes to hide debt and inflate earnings. Enron reminds us that even in the most sophisticated environments, human biases can lead to catastrophic ethical and financial collapse. It shows how the pursuit of success, unchecked by integrity and critical thinking, can become a self-destructive force. The question, and how could they be so greedy? The question is, where in my own life am I building a house of cards, driven by overconfidence, a fear of admitting failure, or the pressure to maintain an image? What small ethical compromises am I making that could escalate? What uncomfortable truths am I rationalizing away to maintain a desired narrative? Because the mechanisms that brought down Enron aren't unique to corporate giants. They exist in our personal finances, our careers, and our daily decisions. And understanding them is the first step to ensuring that our own empires, however small, are built on solid ground, not on the shifting sands of psychological deception.